Good morning, I'm Bill Hubbard, Chief Economist at Trade.com. Welcome to our weekly markets review here on Core Finance, and thank you for showing up today, Mark. Marc Ostwald, Chief Strategist at ADM Securities. And Mark and I were talking really before we started here, is maybe we rename this show This Week's Trump's Tweets.
It certainly has a big impact, probably more his speeches than his tweets, particularly on the dollar and to some extent on risk assets. And it's probably becoming quite tedious insofar as markets are rolling over or steamrolling a lot of the economic data that we've got, which in the US has been largely surprising on the upside, with the exception of the housing data. And even the housing data is a function actually of a shortage of inventory rather than a lack of demand.
And also another thing, as you said, shortages of inventory. And also the U.S. is having the same problem we are having here. Bricklayers, builders, copper tubing, okay? So it's, as you said, it's a function of not having what you need to build.
Exactly, precisely that. So, but instead we are enthralled to Trump and central bankers.
Well, mentioning central bankers, let's look at the first chart. As we see right here, it starts today, Jackson Hole. This is the annual Kansas City Fed gathering, okay? And we have two major speakers today from two major central banks, which everybody, whether you're a euro supporter or a dollar supporter, will be listening very intently to.
Yeah. I think the market's rather more eager to hear what Mr. Draghi has to say tomorrow evening than what Ms. Yellen has to say tomorrow afternoon. I think their priorities may be the wrong way round. I think Mr. Draghi will probably not add a lot to what he said yesterday at the Nobel Laureates meeting in Lindau, talking about the merits of QE and setting out some parameters for the council to discuss where it goes from here. But it's literally just, right, these are the things I think we should be talking about. Any hints on actually what the ECB is going to do probably don't even come at the next ECB meeting in September, but rather in October, because it really wants to see more evidence on the inflation side of the equation before it decides how it's going to taper. We already know that the ECB doesn't want to go down the route of the Fed. I'm not sure whether this is actually misguided, but we know that they don't want to set out a concrete plan, a roadmap. They want to be rather more flexible, which is understandable to a certain extent. And they've already signposted that in the last minutes of the council meeting, saying they want to carve out more room for manoeuvre so that they can move policy in either direction. So we're not going to get much joy out of Mr. Draghi. Ms. Yellen, on the other hand, is going to be talking about financial stability.
What?
Yeah. And I think in that aspect, there's quite a lot of, there are some risks around. She's going to have to tread very carefully here, obviously, because one of the things in financial stability, the discussions will be around, aren't a lot of risk assets very overheated at the moment, and aren't you responsible for it?
Let me just interrupt briefly, okay? People are already comparing her speech tomorrow to Bernanke's speech of 10 years ago, who sort of didn't seem to have a clue that there was a slight subprime mortgage problem developing in the States. And I know a lot of editorials and a lot of pre-reports are saying, will she be as either knowing what's happening and not telling us, or did Bernanke really not know what was really happening, which would be quite disconcerting?
I think there's a balance to be struck here. I think on the one hand, she's probably not going to be as aggressive, because that would invite the question, if you are worried about overheated assets, why haven't you already started with this process of building down your balance sheet? That's the inevitable question. Secondly, aren't you responsible for it? So why haven't you done something about it a long time ago? But what I think the areas she'll focus in on and highlight it as a point of concern is financial conditions, because the one thing that is quite clear, even amongst the dovish FOMC members, is they are uncomfortable with this phenomenon that financial conditions have eased over the last 8 months, despite the Fed hiking rates 3 times. And it's how she addresses that particular topic which is perhaps going to be the most interesting, and it'll also be particularly interesting to see what she says, what areas she says. She won't probably say that the asset values are overheated, but she will say they are at the higher end of what they should be historically. And those ones will be the ones which are then vulnerable.
Because it's quite interesting. You're seeing the people that say maybe she'd be, as you said, the U.S. economy is improving, okay? The inflation problem is transitory, and also I blame that on so much of developed markets now. We're not going to have double-digit inflation ever again. And I disagree with the Phillips curve. I think that's totally outdated. It was outdated 50 years ago. And what's wrong with 2% or 3% inflation, et cetera, et cetera. Now, the other group are saying, will this be a political speech? Will she be saying, well, I would like to be reappointed on the 31st of January next year, okay? And of course, we know Trump probably likes a more dovish Fed Reserve, keeping rates. And I mean, last night, I think, Fed Fund futures only showing a 33% probability of another rate hike in December, and really only showing 28 basis points increase for all of next year.
Well, reapplying for the job, I very much doubt it, actually. I think as far as she's concerned is, back me or sack me. It's about as simple as that. And at her age, I know Greenspan went on for a very long time, but you can understand her wanting to perhaps hang up her boots at this stage. Yeah, definitely. Particularly given that it's going to be a very challenging environment.
Yes.
A political speech, definitely not. The Fed's got in a clinch with Congress and to a certain extent with the presidency for quite some time now, and therefore making outright political statements, she'd probably be thinking, well, actually, I need to set an example here by not getting political. So I think it's just specifically in this whole area of financial conditions that it's going to be the most important thing. I don't think the Fed's particularly concerned that the market's only pricing in a 33% chance of a rate hike in December, because it's looking back at March when it successfully steered the market round in a matter of weeks. And it's a long way till December. And in the first instance, what it wants to do is get on with the process of quantitative tightening.
Yes, I think that's, as you said, I think the market now is saying December is a long way away. We want to see the 20th of September and that official announcement. If no later than October, we'll start winding down our balance sheet.
Yes, yeah, without a shadow of a doubt. And they've concentrated on that because they, as much as it's not going to be particularly dramatic, they're only going to be starting at 10 billion a month. They're working eventually to 50. And now when it gets to 50 billion, then it becomes actually quite substantial. You're talking about the equivalent of the market of the total treasury supply, about 1/3 of total treasury supply every month, now having to be taken up by the market, whereas before the Fed was taking it up.
Possibly the Chinese or the Japanese. And now that we've mentioned the Japanese, I mean, we look at the dollar. It's sort of like this year it's been one step forward and two steps backwards. And basically either the recipient or non-recipient, depending on which way you're looking at it, is our good friend, the dollar yen.
Yeah. It is really quite astounding when one thinks about what market consensus views on Japanese interest rates are, and the fact that obviously in nominal terms Japanese yields are very low. The 10-year yield is basically nailed by the Bank of Japan in a 0 to 0.1% range. However, in real terms, with the inflation rate quite low, actually for the Japanese, at times this year, where you've actually had negative real rates, particularly in Germany with inflation, and here in the UK, and to a certain extent a flat profile to the US when we had inflation, the inflation numbers are up at 2.5 and yields with it. It was quite attractive to invest at home. But of late, a lot of this has been, certainly since June time, that latest rally that we've had since June, has been more about a loss of faith in Donald Trump and concerns over geopolitical concerns. The irony is, of course, is as we've gone down, people have accumulated a fairly big short in the yen because they view Japanese rates as being likely to be the last leg to fall in terms of who's going to be sticking to a very accommodative policy for the longest time. It's Japan. And what we've had of late, obviously, is basically people having to throw in the towel. We got to a stage where I think there was 100,000 short in terms of the CFTC data, and we've still got a 75,000 short. And that's essentially where the problem is. This is the biggest obstacle in many ways to the dollar rallying, but it's also a function, also on the other hand, on the political side, of the fact that people are very worried by Mr. Trump and the fact that he's actually not delivering anything. And the repository for their worries is the yen.
And, you know, right now, I mean, when I left this morning, we were still struggling at that 109 level. I mean, everybody I've talked to and everything I've read is going into Jackson Hole. Do we hold? And the magic number seems to be 108.50.
Yeah, well, that is the big question. I mean, if Ms. Yellen sounds dovish, and I would say, let me construct that in a different way. It's not whether she sounds dovish, it's whether the market thinks she sounds dovish, and a lot of that will be a matter of wishful thinking and wishful seeing. But if it's constructed that way, then you could actually see the yen make some further gains. And the question then is, for the remaining 75,000 short position that we've got on the island, where is the pain threshold?
Yes.
And will the stop hunters, who've been very effective this year in a number of currencies, go after that level to see if they can inflict some pain on the market? 108.50 seems fairly reasonable to me. I mean, you got 108.13, that low from April, you got the 108.83 level. So somewhere in between should be where we find a base. But it's such that if we totally lose faith in Mr. Trump and and Congress, actually, I mean, particularly if we get into this situation where we do get Congress failing to raise the debt ceiling, and you get some form of government shutdown, then dollar yen could actually have some further downside, perhaps even as low as 105.
What would be the pain threshold for the Bank of Japan? Not only, well, both moral and probably, you know, physical intervention.
Well, Bank of Japan has of late, in recent years, been rather reticent to intervene because it already has a huge amount of FX reserve as well as a colossal balance sheet. But at some point, they must be at least looking to make some inquiries about where the bid would be.
Would they be making the inquiries, or would they be getting telephone calls from probably the top 80% of Japanese businesses?
Indeed. I mean, you know, Japan's economy has done rather better in the last 2 quarters than people were expecting. But I don't think there's actually any confidence that what the Bank of Japan's doing in terms of its policy and what Mr. Abe is doing in terms of Abenomics is actually going to deliver anything positive for them. And therefore, if they were to see dollar yen start to motor towards 105, I think the screams of pain would actually be quite loud. That said, a lot of the Japanese corporates have a lot of their production offshore. So the actual yen level is probably most important only at half-year end, which we've got coming up at the end of next month, and at the end of March.
Well, on those depressing notes, at least we haven't had any, you know, ballistic war. We've seen the Korean won and the Philippine peso. But Mark, let me say thank you very much. We'll see what Auntie Janet and Super Mario have to say. Have a very lovely and enjoyable bank holiday weekend, and we will see you next Thursday. Thank you very much for joining us.